Today, in our preparation for the SIE exam, we're diving into one of the fundamental building blocks of the options world, the call option, specifically focusing on the rights it grants and the strategies investors use. A call option is a contract that gives the owner the right, but not the obligation, to buy 100 shares of a specific stock at a predetermined price, known as the strike price, any time before the contract expires. Investors who buy call options are bullish. They believe the price of the underlying stock is going to rise significantly. For a relatively small cost, the premium, they can control a large number of shares and profit from upward price movement. Let's use an exam-style example. Imagine an investor buys one Apple 180 call for a premium of 5. This means they paid $500 for the right to buy 100 shares of Apple at $180 per share. The exam will absolutely test your knowledge of the profit and loss potential. The maximum loss for the buyer is the premium they paid, in this case, $500. This happens if Apple's stock price stays at or below 180, making the option worthless at expiration. The maximum gain, on the other hand, is theoretically unlimited, because the stock price can continue to rise indefinitely. The break-even point is critical to know. It's where the investing neither makes nor loses money. For a long call, the formula is strike price plus premium. In our example, that's 180 plus 5, which equals 185. The investor only starts to profit once Apple's stock price rises above $185 per share. Now let's flip the perspective to the seller, or writer, of the call option. The writer receives the premium and takes on the obligation to sell the stock at the strike price if the buyer decides to exercise their right. An investor writing a naked or uncovered call is bearish or neutral. They believe the stock price will stay below the strike price. Their maximum gain is the premium they collected. However, and this is a major test point, their maximum loss is unlimited. If they don't own the underlying stock and its price skyrockets, they are forced to buy the shares at a very high market price to sell them at the much lower strike price. A more conservative strategy tested on the SIE is the covered call. This is when an investor who already owns at least 100 shares of a stock writes a call option on it. For example, if you own 100 shares of Apple, you could write one Apple 190 call to generate income from the premium. You're essentially agreeing to sell your shares at 190 if the price goes up. This strategy is for investors seeking to generate income from their stock holdings, but it caps their potential upside as their shares would be called away if the stock price rallies past the strike price. A common exam trap is confusing rights with obligations. Remember, buyers have rights and sellers have obligations. To help remember the break-even for buying a call, use the mnemonic call up. This reminds you that calls are for when you think the price will go up, and to find the break-even, you add the premium up to the strike price. Master these calculations and scenarios, and you'll be well prepared for call option questions on the exam.